Hello and welcome to Kotak Life's market outlook for the month of May 2024. The May couple of months preceding which already make us remind of May Day. Rate markets globally have been quite volatile and the spillover impact of the same is impossible not to be felt in India. They say that one data surprise makes an anomaly or an oddity, two makes a line, but three starts making a trend. And for the calendar year 2024, that is exactly where the surprise has come from. From the undying spirit of US inflation, which just refuses to back down in spite of so many rate hikes and tighter monetary conditions out there in their economy. It's not that the inflation parameters are not looking down, it is just that they are probably not going down as fast as many would like them to be, and at least temporarily they seem to be in a phase of rebound, derailing the expectations of markets, which at the beginning of the year were pricing in roughly 7+ rate cut expectations in US and at least 3 in India. Now US being the reserve currency of the world, if the rate expectations there are delayed, I'm sure the spillover in the rest of the world can be felt to more or less various extents. So we are seeing Japanese yen under a lot of duress, we are seeing impact on the monetary policy actions of Indonesia and other Asian currencies, and to a much lesser extent, we are feeling the same in India as well. The narrative on the domestic side since the beginning of 2024 has been quite benign to say the least. Our inflation is on track, our growth looks stupendous. We are heading into an election with at least expectation of a clear majority from the existing government, although elections can give their surprises, but the current expectations don't seem to derail the narrative at least. There has been a minor hiccup in the terms of, say, geopolitical escalations, but the damage to the commodity prices, especially energy prices, as a fallout of the same so far is manageable. There is a heat wave going on in the country, probably disrupting a bit of food prices, but light at the end of the tunnel suggests the expectations of normal monsoon shall take care of what is likely to be a good food produce and hence benign food inflation in the medium term. In spite of all that, the rate cut expectations in India are also getting delayed, largely on account of the global backdrop, and rightly so. So where do we stand at this juncture? Well, our real rates are fairly high and a couple of external MPC members are also suggesting the same. But I think with our growth on such strong footing, such high real rates can be allowed to persist for a little while longer. There is hardly any other reason to disrupt the existing monetary policy setting, as the core inflation, although benign, is probably leading the headline inflation towards the target of 4%. The MPC's expectation of the average headline inflation for the current fiscal year is 4.5%, probably a shade above 4. With normal monsoon and no real further escalation in either global energy prices or any other untoward event, I think we should be decisively on the path towards 4, and the same can be confirmed probably 3 to 6 months from now. In light of that, if the central bank wants to wait out and see how long is the higher for longer narrative in the global, especially in the US economy, panning out to be, I think it is a fairly decent bet. Market narratives, when they change disruptively, so say for example a global market pricing in almost 7 rate cuts in a calendar year, dialing it down to almost just 1 or even less, that can cause a lot of disruption, and the spillover of those disruptions are best avoided. And I think it is in that light that the higher is here for a little longer than most expected the longer to last. In light of the same, domestic interest rates are also likely to be in a reasonably safe range, if I may say so. Also, June is the month where we are likely to see the onset of India's index inclusion flows. So while the index inclusion was expected to bring about flows of anywhere between $25 to $30 billion, roughly $10 billion have already come since the announcement as the front-running flows. We would still expect another $15 to $20 billion of index inclusion flows, putting a lid on at least India's yields going further in solidarity with global yields, if at all. Overall, we expect range-bound rate markets, and this window of relatively higher rates compared to last quarter as an opportunity to enter and create position in India's debt markets, as an opportunity to capture the rally when the rates eventually and are decisively being cut in line with not just local but even global monetary policy cycles. Thank you and happy investing.